What's up, gang? Thanks for listening to the Undiplomatic Podcast, the show with undiplomatic takes about the foreign policy scene. I'm your host, Van Jackson. My guest today is a political economist at the University of Queensland. He's an Australian Research Council Future Fellow, which I was at a conference recently and I found out that that's a big fucking deal. It's extremely competitive fellowship, but like if you're not in Australia, maybe you don't know about it, right? And he's published a lot, including a recent book that he co-authored with Cambridge University Press called Fractured China, How State Transformation is Shaping China's Rise. It seems like that figures into the argument that we'll talk about today. And the reason we got him on the show is because he has a new journal article out with Lee Jones, and it's in the journal International Affairs, and it's called China, International Competition, and the Stalemate in Sovereign Debt Restructuring Beyond Geopolitics. My guest is none other than Shahar Hameiri. Welcome to the show, man. How you doing?
Yeah, great, man. Thanks for having me.
Yeah, I'm really glad to finally get you on here. We've flirted with this for a while, and the stars never aligned. But
Here we
this,
are.
yeah, this article is brilliantly argued, and I mentioned when we were coordinating the prep for this episode that like I wish I had seen this article like 2 or 3 months ago, because I just finished co-authoring a book about not this topic, but about like geopolitical competition with China. And the way my co-author and I kind of sized things up, it was a political economy first interpretation of rivalry. And like we kind of came out saying there are geopolitical implications to China's political economy, but China's economic footprint in the world is not primarily driven by geopolitics. And you guys converged on that from in your own ways. So actually, I want to obviously we're going to talk about that, but before we get to the article, I should probably mention like the topic of debt trap diplomacy, which a lot of people will be familiar with, but some maybe not. You made a big impact on that debate. So in the Trump years, well, actually, let me just turn it over to you. The topic of debt trap diplomacy. What is it? And then what is this grand research intervention that you made a few years ago? What did you find? How did you weigh in on that?
Yeah, thanks, man. Look, I mean, debt trap diplomacy is one of those zombies that just we can't seem to be able to kill, keep coming back. It's essentially, and I really like the way that Deborah Bradingham, she wrote a paper about it, and she called it a meme, and I think that's quite actually a nice way of thinking about it. So basically, it's an idea that emerged in an Indian think tank and somehow very, very quickly moved around, ended up in the highest court of power, especially in the United States. And essentially what it says is that China is lending developing countries too much money on purpose with the idea of getting them into a debt trap or some kind of debt distress, and then using that debt trap in order to get access to strategically located assets. The most
ports and
infamous
stuff.
one, ports and things like that. The most infamous one, and that's the case that kind of raised the whole issue up to the highest levels of attention around the world, is the port of Hambantota in the south of Sri Lanka. And we can talk about that a little bit more if you want, but basically people began to argue that China lent Sri Lanka too much money in order to get access to that port. And essentially that idea has been floating around ever since. It was reiterated by senior policymakers in the United States, both administrations, definitely the Trump administration, but also more recently, Biden, if I remember correctly, called the Belt and Road Initiative a debt and confiscation plan or something like that. So it's not like the current administration doesn't use the same ideas. Now, I would never argue that countries that have borrowed big from China can't get into a debt problem. Of course they can, as part of a wider range of, perhaps, not very clever borrowing that happened and when the times were good. That's not a new story in international politics. I mean, debt problems.
Debt distress is like a global problem in a way. Yeah.
Absolutely right. And many of these countries borrowed not just from China, they borrowed from bond markets. They were willing to give them lots of money at one point because, especially of quantitative easing, when global liquidity was very easy, they could borrow from bond markets. They also borrowed from other providers, sometimes from banks, sometimes from other governments. So they have a debt problem, and China is part of that mix. And we do recognize that in many cases, Chinese lenders were not lending with sufficient, if you like, consideration for the potential for repayment problems, especially when times were very good in China in terms of lending around the kind of middle of the last decade, say 2013 to 2016 was the peak. But after that, things have really tightened up. And China is part of that story, but there is absolutely no evidence that I'm aware of that it was done on purpose. And that's what we've argued against in that paper. And in that paper that you mentioned was published by Chatham House, we looked at the case of Hambantota specifically, but we also looked at what happened in Malaysia, two very prominent cases of the debt trap thesis, and found that the story that was being told about them is not actually the story of what actually happened in those places. And I think that's quite important.
What's the snapshot of what actually happened, like the short version?
Yeah, in Hambantota, the version is the real version, if you like, is that the idea for that port has been around for decades, really, going back many decades. And Sri Lanka tried to finance it in different ways previously. The couple of feasibility studies that went out at different points in time. And then at one point, China being able to or starting to finance projects around the world, largely to do with the internal problems or the internal issues that were affecting the Chinese economy at the time, which we can talk about, was able to finance that project. The project was being built, and the port was actually run by the Sri Lanka Port Authority. At that point, it was quite unsuccessful, didn't manage to bring in a lot of ships. And then Sri Lanka, after a change of government, got into a bit of a debt problem. It was a bit of an early sort of like the canary in the mine for the more recent debt problems that are affecting many other countries. And largely, it was a mix of things, but it was partly Chinese lending, but also bond market lending that got into that debt problem. This is around 2015, 2016. It had to go to the IMF to get a rescue loan from the IMF, which is something that Sri Lanka has done many times in its history, unfortunately. The IMF said, well, you've got to privatize a few things, which is not unusual for the IMF, as many of the listeners would know. So they decided, partly because of the association of that port with the previous regime, to privatize the port. They looked around for whoever's going to take it over. It ended up being a Chinese company that specialized in these kinds of projects. They paid 1.1, if I remember correctly, dollars for the lease of the port, and that money was then used to pay down other debts that Sri Lanka had, not its debt to China necessarily, but it was definitely no debt for equity swap, which was how it was presented at the time, where China was given money in order to gain equity in the port. The underlying loan to China to build the port remained in place subsequently. So it's just a classic story of a country getting into a debt problem, going to the IMF, privatize, using the money to pay down its debt. But that story was being told as if from the very beginning, the port was financed in order for China to be able to seize it at one point. And the company that currently runs the port has been actually making some pretty serious efforts to turn it into a more successful port, and they've had they've had some success in that respect. So the port is now a lot more, a lot busier than it used to be at one point. But it's not being used by the Chinese Navy or anything like that, which were the kind of claims that were made at the time about it.
Yeah, I mean, and so among the important implications from what you guys found in your research seems to me at a minimum that like the Sri Lanka port issue and what was not even a straightforward debt equity swap was being heightened or elevated, or there was like a paranoia around it. And I mean, it's hard to call that anything but like threat inflation, and what it was threat inflating was just like normal business under global financial capitalism. I mean, right? I mean, that's like
in this case, yes. I mean, if you're the Sri Lankan government and you want someone to take over a port, because you need to privatize, you need to do something about your debt and so on. It would have been likely for a Chinese company to win that contract, because this particular company has a history of doing similar developments in other parts of the world and making them reasonably successful. So in China, but also in other parts of the world, they sort of I don't know if they're pioneered, but they are one of the leading companies in this kind of model of development where you build a port, you build an industrial park, you build residential sort of development around that as well. And that's what they're renowned for. So they're trying to kind of get the company that knows how to do things to come in and run the port. And from my understanding, I mean, I've not been there, since they've taken over. My understanding is that the port is working a lot better than it used to in terms of the throughput, of ships and so on. But it's definitely not become a Chinese naval base or anything like that.
Yeah. Very smart intervention. And yet the debt trap diplomacy narrative sort of, what'd you call it? Like a zombie
It's
narrative or
zombie,
something?
it's a
Yeah.
meme
Like it
zombie. I don't
doesn't
know.
die. Yeah. You put a stake in its heart and it's still walking around. Yeah. So on the international affairs article, which is the much newer of your research, and it's not unrelated to the debt trap diplomacy thing in a way. The gist of your argument, I'll try to summarize it in like a sentence, but just correct it if it's off. But like, you guys are saying that like this decade and a half of sort of loose, generous Chinese lending was generous in a like self-interested way, was primarily not because of geopolitical considerations, but there were actually just highly favorable domestic conditions in China and in global financial markets, and those things incentivized China to push capital surpluses abroad. Would you like amend that in some way, or?
No, I think that's absolutely right. I mean, essentially, China's economy, the growth model has been in trouble for some time, really, even before the global financial crisis, but the global financial crisis of 2008 made that even worse. Because up until that point, the basic model was it was kind of a virtual cycle. So you export, you gain some surpluses from that, you invest that into infrastructure, your capacity grows, you export more, and so on and so forth. And that was the domestic development model in China, essentially. And it was, we can talk about that maybe later on, but because of that fractured China notion that we put out in the book, a lot of that was actually done in a way that generated a lot of overcapacity within China, because there's considerable competition between localities, between provinces, and so on, that created a lot of excess capacity. So at some point you get to the global financial crisis and exports just fall off a cliff, because the West was in trouble. So then the model essentially starts to kind of get out of whack a little bit. China tries to maintain growth by investing, getting local governments and others to basically borrow money to continue to build infrastructure. They build infrastructure, but the returns on that investment is becoming pitiful in many cases, in many cases below the cost of capital. So there's the kind of basic problem there. You have overcapacity in a lot of relevant industrial sectors. That overcapacity is mainly in the hands of state-owned enterprises, which politically are very important in China. And then at the same time, you have an overaccumulation of capital that cannot be invested profitably within China. So these two problems, which are, like I said, nothing new, they're the ones that essentially drove the Belt and Road Initiative when it emerged. And the Belt and Road Initiative, which many listeners will know was announced in 2013, actually just scaled up something that was already happening. So the same kind of stuff was already happening for a number of years.
It was like rebranding or collective.
Rebranding, yeah. That's a nice way to put it. So it was a nice brand to put on top. Now, no one's arguing that someone like Xi Jinping and people around him didn't see maybe some geopolitical potential for something like that, but that's not how it was run. It was run by the National Development and Reform Commission, which is the kind of industrial planning body within China. And some work that's been done about this, mainly by Lee Jones, with whom I've co-authored this paper, shows that it was very fragmented in its delivery. So it's a bit of a free-for-all for a while. Conditions, as you said before, were very amenable for lending at that point, both in terms of China pushing out all this excess capacity, both of capital and of industrial production and labor and so on, but also in recipient countries, which at that point were enjoying, for a number of reasons, a really easy access to credit, both from China and elsewhere. So it had some to do with quantitative easing after the global financial crisis. It had some to do with previous rounds of debt relief, which opened up some fiscal space for them. It had a lot to do with the commodity super cycle, as people called it, which was a period where the resources, the mineral resources of many developing countries, and Australia, of course, my home country, were enjoying historically high prices. So again, that made it look like there's a lot more fiscal capacity, and all these things combined together to create this lending boom that happened mainly in the middle of the last decade. And again, what we made clear in the paper, it was not just China. China was a big part of it, but actually bond markets were lending even more. And many countries are able to get into bond markets for the first time ever at that time, because markets, when they're more risk averse, would not lend to, say, countries like Ethiopia and others, but at one point they're willing to actually buy their bonds. And ultimately, these conditions shifted, creating the debt problem and creating that stalemate in international debt restructuring negotiations, which we talk about.
So the buoying, as in like keeping afloat of both like global South countries, but also China's economic model, which was reliant on generating capital account surpluses by doing a lot of exports, which disproportionately went into America, ironically. But like that whole model and keeping it afloat and keeping the global South afloat in a way was based on this. I keep saying generous lending. I can't, like, large scale lending, I guess is what I mean to say. And so, and that lending is being done, and this is where the fractured China sort of lens comes in, because Chinese lending runs through local and regional, like provincial banks. Yeah. And they're not centrally coordinated.
It's
And
not
that,
so much local and regional, but the main lenders in that period were the so-called policy banks in China, which are the Export-Import Bank of China, or Exim Bank, and the China Development Bank. So both of those were lending. They have slightly different roles, but I don't want to get into that too much. But they were basically lending, and they're lending for a profit. Exim Bank has a bit of a concessional lending aspect to it, so it makes it more like a, like an aid agency in a way, not exactly, but mainly in the form of concessional export credits. But most of its lending is done for a profit at non-concessional market rates. And the same goes for China Development Bank. So these bodies are meant to serve the policy goals of the Chinese government, but the way that they're structured and how they raise their financing and how they make decisions about projects typically means that they're the one that essentially decide whether to put money into lend for particular projects. They are definitely geared towards advancing the international expansion of Chinese state-owned enterprises and Chinese business more generally. So that's kind of overarching, if you like, logic of the system. But at the same time, it doesn't mean that Xi Jinping is sitting there with a white cat, stroking it and telling them where to lend, because actually that's not how it works. Generally, there's various ways in which projects can come about, but they're the one that ended up making the decision about whether to lend the money, and they want to see returns on that money. And this is really important. If we go back to that point about the debt trap diplomacy, if a country is in financial trouble, the debt trap thesis argument is that these lenders would then seize assets, take equity in assets in return for debt write-downs. Well, that's never happened. Why? Because the Chinese lenders don't want to hold basically worthless equity on their books. Well, they don't want that. They want to get repaid. It's very important for them. And we can talk a little bit more about why they're constrained in that respect. It's very hard for them to write down bad loans that happen in other countries. So they want to get
Chinese firms would much prefer repayment over having to take equity somewhere. Yeah.
That's right. And the thing is, there's a lot of evidence for Chinese lenders creating these contracts that create escrow accounts that sit overseas that allow them to draw cash out of these accounts if there are repayment problems. Sometimes that's portrayed as fairly predatory practice, and I guess it is, but it's not unique to China. But the point is, they want cash. It's not the same as holding some port somewhere and then making it work, which is a lot of work, and they don't want that work. So that's quite a different story to the one that's often told about it.
Yeah, definitely. That raises the question of like how that argument contrasts with the sort of, I guess, dominant geopolitical interpretation of China's foreign lending. Like by your conclusion, you're basically rejecting that interpretation. What would you say that interpretation is, and like sort of what's off about it?
Well, the basic idea we mentioned before that was out there is that China was lending for geopolitical reasons. That often that lending was targeted in order to, win over certain governments or to get access to certain resources, and that in some cases it was done as a debt trap strategy, right? I mean, so that was the argument that was out in the 2010s.
The idea, though, being that I'm just trying to peel back a layer on what is meant by geopolitical, like to control territory. Is that the idea? To control
Well,
polities?
control polities, control governments, control key resources, control
Just a
key
hegemonic view of,
networks,
yeah.
key network, control key trade routes, perhaps things like that.
Mhm.
And that's the basic narrative that emerged in the 2010s. Now, there could be, by the way, I'm not saying that maybe after the fact there won't be something emerging that looks a little bit like those things, because we know that things can have
The
a way of their
implication,
own.
yeah, yeah.
But at the time, that was not what was driving the lending. What was driving the lending is what I was saying before. And there's a lot of evidence to show that the lending that was being done was really quite scattergun. It didn't match any kind of template or any plan map that was out there in relation to what it should look like. So lending was happening just as much outside of the corridors that were announced as inside the corridors. It was just as likely to, finance a project outside of them than inside. But the flip side of that was that the West was reacting to that, either via the World Bank and other multilateral development banks, but sometimes more directly by responding in their own way to that geopolitical challenge that was put over by China. And the recipients were benefiting from that because they had choice. That was the kind of positive spin on that lending boom of the 2010s. So if you're a recipient country, you've got China on the one hand saying, we're going to do this for you. And then the United States, say, on the other hand, is saying, well, we don't want China to win here, so we're going to do this for you. And they could sort of play them off a little bit. That was the basic idea that was emerging at the time. But the thing that really struck us, and this is, I guess, where the paper started, one day we just had this conversation, we're just saying, well, if competition was meant to be this great thing for recipients, why are people saying now that competition between providers or creditors is what's actually jamming the restructuring process? It doesn't seem to make sense. Because if the lenders were competing over the allegiance of these global South countries, why aren't they competing to give them a great deal? Why aren't they actually saying, well, they're going to cut 80%, we're going to cut 90%? I mean, you would think that if that was the rationale, or at the very least, let's see China spring in debt trap. We've been talking about this for a long time. A lot of countries are on their knees right now. This is
Where's
the best
that?
time.
Yeah.
Just go. I mean, and it wasn't happening, right?
Yeah.
Neither of these things was happening. And that, to me, deserved an explanation.
Mm-hmm.
So if you had that geopolitical lens to begin with, it doesn't make a lot of sense, because there could have been a lot of ways in which China could have mobilized the current debt crisis in order to advance geopolitical interests understood in this way, in the way that we just described. But neither of those things, or none of those things was really happening. So then to explain that, we had to kind of peel back a little bit, and kind of look at what was actually going on, going back to the story of that lending and the stuff that we already talked about. So how did it come about? What was it about, right?
Mm-hmm.
And then also try and see how that now manifests in debt restructuring negotiations, which many listeners will not know, but basically they've gone nowhere for many years. I mean, there's some countries that have really been negotiating with their creditors now for over 3 years, which is a very long time to be in default, and really have not been able to reach an agreement. And sometimes, there were some agreements, but then they didn't lead to final agreements and so on. So it's been a very tough kind of few years for distressed debtor countries. So in order to explain that, we had to, again, through this lens that looks at what the various Chinese actors are actually seeing and what they care about, and in this case, mainly the policy banks, and the People's Bank of China, which actually owns a lot of shares in the policy banks. So if you look at it like that, you see that what they're seeing is not the United States or Japan even, or anyone like that. They're seeing the competing creditors, and the competing creditors are not those countries which have never. I mean, Japan is a little bit different, but most of its provision comes in the form of aid, so it's not so much big debt like like say the kind of lending that China was doing, but they're looking at the world and they're seeing bondholders, they're seeing the multilateral development banks, and they're seeing those other big sources of credit to developing countries as being in a much more advantageous position than them. So that's what they're worried about, right? And because of that, negotiations have not really been able to proceed.
Yeah, in the book that I just finished writing,
Looking forward to reading it.
yeah, I think you might have some criticisms, but I think you'll like it in the main. One of the recommendations that we have sort of at the end, where you're putting a bow on it and being like, well, what is to be done, is like, well, one of many reasons why we have to sort of unfuck. This is a vulgar podcast, sorry.
That's okay.
Unfuck the rivalry
I
process.
understand French, it's all right.
To the extent that we can, like, it takes two to tango, but like unrivaling the great powers to the extent that it's possible is really important, because like you can't get the CCP to override fractured economic governance in its own country unless there is some grand reframing, like an imperative to do so. And so if you just let um, debt servicing and debt relief negotiations proceed organically, the Chinese state itself doesn't really have any incentives to like do anything differently unless it's truly hegemonic in its ambitions and wants to dominate and therefore wants to show up the US. But we're not really seeing that. Like you said, it's slow going, like brutally slow going if you need debt relief or if you're in debt default, Yeah, and so like there's scenarios where the US has things that it could sort of undo, tariffs and stuff with China, where there could be something like a quid pro quo, or like a larger reframing of the relationship, such that China has incentives to start suspending more and restructuring more debt, but on its own terms, because of the fractured way that China manages through these linkages like the Exim Bank and stuff, that there's just not like this weird slow destruction of smaller countries basically is not really going to change. Actually, there was a question I had about that. Since the pandemic, the G20 had this debt service suspension
initiative,
yeah,
DSSI.
yeah. And so China's part of that, and on the one hand it has suspended repayment requirements for a decent amount of its debt recipients, or loan recipients, but the amount was like 40% to 60%. It's like much lower than the average debt suspension of other lenders. And so or like Paris Club members specifically, how do you explain that, or how do you account for that? Like, what does that tell us? The fact that China's not writing down more debt,
Well, suspension and writing down are not the same thing, right?
Right. Yeah. There's
whole
categories here.
The world of debt restructuring is incredibly technical and complicated. But basically, what China has always been reasonably willing to do, when I'm saying China, I'm talking mostly about the policy banks, right? They're the ones who make those decisions. They're the ones who sit in the committees and so on. So they don't mind suspending, and they don't mind rescheduling too much, meaning, you start paying in 2 years, take a break, come back. Usually they don't mind that too much, but they really don't like reducing interest rates, and they really don't like cutting debt, like literally
writing
just
off losses.
And these are really tough things to negotiate, and there are many domestic reasons for that. And the reasons are, for them, it's very hard to write down debt. There are no proper processes within China for doing that. I believe that one day these processes will have to emerge, because there's such a bad debt problem both inside and outside China that they'll need to work out how they're going to deal with all those bad loans out there. But as yet, there isn't. And then if they want to write down debt, they have to go to the State Council, which is China's cabinet, and ask for them to approve it. And they don't want to do that because that's career suicide from the perspective of all the people involved. So essentially, they try to kick the can down the road, hoping for things to improve one day. And this is actually something that in a great paper also published in International Affair by Muyang Chen, she argues that essentially they're behaving very much like banks, Western commercial banks did in the 1980s, and how the Paris Club governments also behaved in the 1980s. So there's a bit of a mix here, right? Because the separation between public-private is not so clear in the Chinese case. But essentially, this is the so-called new money approach, which assumes that countries are suffering from an illiquidity problem, not from an insolvency problem. So if the problem is just lack of liquidity, you can give them another loan and you can kind of kickstart repayments, and then the economy recovers and everything will be fine. But actually, in the 1980s, they did that for a while, and then they realized that actually the problem was insolvency. They'll never be able to repay the debt. And that's when you have to start doing bigger things like cutting debt and so on. Of course, don't get me wrong, the way in which it was done in the 1980s and 1990s was absolutely, atrocious from the perspective of the recipient countries. I mean, this is all the stuff about IMF and conditionalities.
That's predatory, yeah.
So I'm not saying there was any kind of benevolence there, but we're not even there yet now. So at the moment, the way that the Chinese banks are talking about this is very similar. They're saying, well, actually, maybe if we just lend a little bit more like a rescue loan, maybe if we'll just hold off payment for a year or two, they'll come back and we'll be able to repay. But I don't think that's going to happen. So something's going to have to give at some point. And exactly what that's going to be, I'm not entirely sure. But given actually the real geopolitical tensions that exist between China and the United States and other countries, it'll be very hard to work out a deal. I mean, this is probably what your book is about, which is very important. But one of the things that does display a very strong geopolitical angle to this whole thing is the way in which the West writ large, the United States and so on, are not actually keen to get the MDBs involved in debt relief because the multilateral development banks, they are the main shareholders of those banks. So they would have to carry some kind of the cost of if they were to provide debt relief, those countries would have to carry some of the costs. And I don't think they are willing to lend that kind of helping hand, both the recipient but also to China, because they sort of, again, this is this kind of zero-sum game also between creditors. They believe that China has made its bed and has to lie in it in a way, lent too much money, made mistakes, basically deal with it now. But from the perspective of recipient countries, they're kind of stuck in the middle. They can't get debt relief from MDBs, which are normally excluded from debt relief anyway. But in this case, maybe there is some kind of a good case for them to be involved because the amount of debt that countries owe them is huge. And China, on the other hand, is saying, well, why are we the only one that are expected to cut here? MDBs are not cutting because they're excluded. Bondholders always get a great deal, always. They get a much better deal than actual creditors, than governments. So it's basically just us here. Why are we supposed to carry all the costs? And that's kind of where things are sitting in a way. And it's hard to see a way out. You mentioned that DSSI initiative. Again, that was easy for China to do because it's in line with the stuff they've already done for years, which is, let's just cut for a bit, come back in 2 years' time, repay. But then the common framework, which was the follow-up initiative of the G20, the common framework actually should involve debt relief, like real debt relief. And it's not been playing out very well at all. It's not really been able to, essentially no proper deal has been cut under the common framework since it was announced, which was in late 2020.
Yeah, it's actually, I don't want to get on a tangent, but there's an immense amount of like societal and human suffering that's going on in the world, and that's inflamed because of national governments' inability to pay debts, or to, even when they're even debt servicing what they already owe, it's coming at the expense of funding their own government, their own public services and the
Absolutely.
like.
It's better usually if they default. If they default, sometimes they're in a better place, but if they continue to service, I mean, you see now Kenya issued essentially a new bond at 10 point something percent.
Mm-hmm.
So Kenya's not in default, and the market would buy their bonds.
Yeah.
But clearly these bonds are meant to pay down existing debts, but actually they're making the debt pile more expensive.
Yeah.
So who's going to
It's
pay the price of that?
non-productive debt accumulation. And like, yeah, it's compounding future problems. Yeah. And I don't know what to do with this insight. Maybe I'll write it someday, but like there's the idea that like you're ratcheting sort of human suffering at scale via this mechanism of debt and like the distress that governments are under trying to sort of manage it and not really having future prospects, the debt's not being directed toward productive investment or that kind of thing. And so this suffering is the wellspring for all kinds of bad shit in the world. Exclusionary politics, ethno-nationalism, jingoism, where there's mass human suffering, there's bound to be grifters and, kleptocracy formations and like all this stuff. And all of that lends credence to very superficial realpolitik narratives about our current age as being like the age of violence and this kind of shit. But it's like it's not it's not that way. If it becomes that way, it's not that way because there's one or two supreme bad guys in the world and we just have to confront them as if they're the bad guys and thereby we shall create a better world. Almost nothing about that is correct. Like we have a mechanism that calibrates world politics indirectly and the suffering in it via something like debt or the inability to relieve debt or restructure it. And that is like human suffering is pouring forth from it. And those are the conditions from which all kinds of nasty politics and nasty geopolitics sort of get attached to our reality. I don't know. There's something here about like debt and militarism and geopolitics that is like really disturbing me. And the fact that rivalry itself makes it harder to resolve this thorny issue of debt relief, like proper debt relief, is disturbing to me.
Oh, look, I think you're absolutely right. There's a really good book that was published, I think, in 2019. But I think the author's name is Jeremy Roos, if I'm not mistaken, and it's about essentially that history of default. And the question, I think, the title is a question, which is why not default, essentially. And
I
the
need to
author
look this up.
shows it's a really good book. I would recommend it to the listeners.
Yeah.
Essentially, the author shows that in the past, countries used to default unilaterally a lot more than they do now. They just used to repudiate their debt, just go, you know what, fuck it, we're not paying.
Yeah.
And these days, they don't do that anymore. When I'm saying these days, I'm talking from the 80s onwards, really. And there's a really interesting argument in there about the interplay of IMF lending, the necessity of access to financial markets these days, and also the way in which elites in many of these countries benefit and buy into the necessity of repaying debt. So it's a big steaming mess, really, and it's very hard to disentangle. But absolutely, geopolitical rivalry is not making that easier. But again, if geopolitical rivalry in a traditional sense was what was driving it, you could see how in order to win friends, say China or the United States, or when the United States could do via the World Bank or some of the MDBs, because directly doesn't actually lend that much money. But you could see how they could, in order to win friends, maybe cut some of the debt or do something like that. But that's not actually happening either. So there's a number of layers and levels here operating at the same time, and unfortunately, we're sort of yet to kind of untie this Gordian knot. It's a real mess, and from the perspective of the recipient countries and their populations, it's quite brutal. But it tells you something interesting, and it tells you something that I think has wider relevance, which is that it's not necessarily the case. The growing geopolitical rivalry between the United States and China, whatever bloc emerges, is going to be good for third countries, right? Because there's this kind of idea that if the big boys are competing, then you can sort of play them off against each other or something like that. But actually, I think there's increasingly evidence that that's not the case. So that's even more worrying.
Yeah. No, that was I meant to ask you about that. Like that was one of the huge implications of this paper, was that you're kind of puncturing I wouldn't call it a myth, but like you were definitely puncturing the optimism of that age of choice narrative. Like, oh well, small powers are gonna collect a windfall from Cold War politics, and like you suggest reasons to think that like that's not really the case, especially when you look at how little debt relief is actually happening and how much debt is accumulating all the while. um,
I think
yeah,
the argument holds water a little bit better when you look at kind of major middle income countries like Indonesia, India, perhaps Brazil. I think they have a little bit more leeway in a number of different ways. They've got very large domestic bond markets and very sophisticated ways of trying to manage exchange. A lot of that, by the way, ends up falling on the backs of their own population when things go wrong, right? I mean, this is this kind of the game that you play. I mean, if you want to maintain your various debt commitments, sometimes you have to turn into a bit of austerity internally, but they seem to be able to do that a little bit better than some of the smaller countries, which are really struggling. And yeah, I mean, the IMF suggested around 60% of those low and lower middle income countries are currently in debt distress or about to get into debt distress, and there's some pretty frightening figures. But we're not going to get, and this is, I guess, important as well, we're not getting a kind of systemic crisis that was emerging in the 1980s in a way that at that point, the countries that were suffering from big debt problems like Mexico, like Brazil and others in Latin America, if those countries stopped paying, the American banks would have basically collapsed because they're heavily exposed to those countries. That is not the situation that we have today. Today, certainly human suffering is a big aspect of what's going on. Certainly a lot of countries may become hotbeds for all sorts of problems because of these debt issues. But I think the global financial system as a whole is not as exposed to what is going on at the moment as it was back then. I don't know if that's a good thing or a bad thing, but that's just something. I mean, there are many other things that could collapse the global financial system, but it likely will not be the global South debt problem.
yeah. There's an analog to sort of climate change where it's like the persistence of the problem, exacerbating the problem, it inflames human suffering at scale, but it doesn't necessarily threaten the international system. And as long as it doesn't threaten the system, something like the 80s, let's say, you don't have narratives concentrating our focus on it, and therefore the pain kind of gets sublimated or something. Like it's kind of in the background. You can choose to ignore it, you can prioritize other things instead. And so like that part of it, I guess, is concerning to me. But yeah, I take your point. um God, this sucks. You meant, well, so this is slightly out of scope of the paper, but it does touch on it. Do you have a sense of whether institutions like the World Bank and IMF have curbed their own practices or demands for austerity and deregulation when they make loans in response to the competitiveness from like Chinese overseas lending over the past decade and a half? Or is it
Well,
not?
yeah, that's a great question. I haven't done that work myself, but I know that people have done the work, and they've shown that where there is competition between the World Bank and, say, a Chinese bank,
Mhm.
usually the World Bank issues fewer conditionalities. And there's similar work that's relating to the IMF. Certain countries, whether they are closer to, say, the United States or whether there's an element of competition, sometimes the IMF also issues fewer conditionalities. And maybe that is a relatively positive aspect of the competition. However, I don't think we should overplay this because certainly the IMF, when it goes and offers these rescue loans, this sort of international lender of last resort type loans to countries, it still demands a lot from them.
Yeah.
To that extent, it hasn't really changed all that much, I mean, when they talk about the global economy more generally, when they talk about all sorts of things, you can see the IMF certainly has people now that think a little bit outside the square. We're not just singing from the same, hymn sheet as the 1980s anymore. However, when they go out to a small country or, some country in the global South that wants a rescue loan, they still demand basically the same stuff. They want to see, basically what they want to see is a current account surplus, right?
Yeah.
that would allow them to repay their debt. That is the bottom line. I mean, strip away all the ideology. What do you need to do? You need to repay your creditors. Often they're international creditors. So you need to be running current account surpluses. And you need to be running current account surpluses by hook or by crook. Like, doesn't matter how.
Yeah.
Cut
If that means
budget.
cutting public spending, then that's what you got to
Whatever you
do.
have
Yeah.
to do, that's where you need to get.
Yeah.
Raise taxes, do this, do that. So that's basically what they're doing, and they continue to do that.
Yeah. I would love to see a study of the gap between World Bank and IMF analysts versus the decisions that these institutions make, because it feels like the gap is widening, where the analysis is getting better and recognizing some of these realities, but then the policy implementation of the World Bank and IMF is, I don't know, to me it doesn't look much different than it's ever looked, yeah.
Well, one of the interesting things about the way that the IMF looks at the world is essentially they are, I mean, they wouldn't call it them, but a lot of how they think about the world basically wraps up political economy, right? Because it sort of has a political economy lens built into it. Because when they talk about debt sustainability, they put all sorts of figures on this and they quantify it in different ways and they have different kind of criteria on that. But fundamentally, what it comes down to is, can a society take that level of suffering in order to achieve that target, right? That's what frames a lot of that stuff. That's underneath that. Because ultimately, when you talk about some kind of recovery from default and you talk about these plans and rescue loans and so on, that's what it's about. It's about, what level of suffering can a society take in order to extract all that money to be able to repay the creditors at a certain rate. And that's fundamentally what it is. And some societies don't get into default because, for whatever reason, the government has a capacity to impose a huge amount of punishment, really, on their society and extract a lot of resources and repay the debt, right? I mean, so ultimately, that's what it all comes down to. It's your capacity to extract and repay creditors. And the IMF knows that. I mean, that's sort of implicit in a lot of their plans. They will never say it. I mean, this is not something that they would actually put out there, but that's where it comes from. That's the reality of debt.
So Chinese development assistance has kind of tapered off since 2016. Do you have an account for, or like a hypothesis for like why that is?
Yeah. So firstly, if anyone among your listeners, or even you, of course, want to get all the details, no one does it better than A-Data, right? That's a bunch of people that work College of William and Mary in the United States. That they basically do a global public service in that place. I'm a big admirer of their work because they have big teams that essentially scour a lot of sources of data and create the only comprehensive database of Chinese lending projects, contracts. They've got a lot of stuff. If you want to kind of get the data, that's the place to go. Late last year, they released their latest report. I think it's called Belt and Road Reboot. Now, I don't really agree 100% with their framing in that report, but the data is invaluable, and we used it for this paper even. So essentially, the reason why Chinese lending is tapered off has a lot to do with a number of different things. So firstly, like we said, the international environment for lending has become worse in that period. And I think that's important, not to mention the pandemic, which created massive problems, but the amount of lending we're reducing even before the pandemic, right? So the Belt and Road Initiative created a lot of headaches for China, a lot of bad projects, increasingly problems in repayment. Increasingly, countries were becoming less willing to borrow from China as well for a variety of different reasons, both because their own costs of borrowing were going up as world interest rates were, the cost of borrowing was actually going up for all of these countries at that point, but also their debt piles were going up and so on. So that was already happening. But also the really important, and I don't think we can ignore what happened in Venezuela, which was a very bitter experience for Chinese lenders and reduced their appetite for lending quite a bit. And that happened in 2016. And you can really see the amounts reducing quite a bit after that. So essentially,
can you give a snapshot of what happened in Venezuela?
Yeah. So basically what happened in Venezuela, that was the biggest borrower of Chinese development financing of all, okay, Venezuela. And as is often the case with Chinese loans, and again, this is meant to be some kind of a risk mitigation strategy. A lot of that stuff was backed or was meant to be paid by the receipts from oil sales, right? And again, this is not a model that China invented. Actually, China was a recipient of that very model from Japan in the late 1970s, but let's not go over sort of this whole thing. So basically in 2016, Venezuela, this is a kind of a slow burning crisis that was going on there. I'm not an expert on Latin American politics, but just in a nutshell,
Sure.
The Venezuelan regime was basically convulsing, and Venezuela's sanctions were imposed by the United States, and essentially Venezuela's capacity to extract and sell its oil declined. So the underlying, basically, if you like, asset or the underlying collateral for a lot of Chinese lending was actually collapsing. The
Yeah.
value of that at the same time as essentially Venezuela was struggling to actually get the foreign currency to repay China, because China usually lends in US dollars, at least used to. So both Venezuela's capacity to repay was declining, and its capacity to sell and extract, even its capacity to extract oil, like the physical capacity, was declining. So this was the one case that I can think of that where China essentially, and we don't know exactly what happened internally, but it did write down significant amounts, and this could be perceived, if you like, as a case of a lender trap, not a debt trap.
It doesn't want to end up in that position again. Yeah.
Yeah, and after that, they really got burned, and they became a little bit more careful about where they lend and how they lend. And then, of course, came the pandemic, which made it even worse. And basically what's happening at the moment, firstly, the amounts have dropped off enormously. So if you're looking at a peak of, I don't know, say 130 billion or something like that a year in 2016, now it's about maybe 50 odd billion. So it's obviously a lot lower. I can't remember the figures off the top of my head, but it's somewhere in that vicinity. But 60% roughly of what currently is being lent is rescue loans given to distressed borrowers. Now, some listeners might hear that and say, well, this is a classic case of basically China, geopolitically kind of responding to propping up its various cronies. But that's not exactly what's going on. So, I mean, there is an element of that. I'm not saying it's not entirely part of the story, but essentially, this is a classic example of an attempt to rescue your own lenders, because those countries that receive those emergency loans are all among the biggest borrowers from China's policy banks, all of them.
Too big to fail from China's
Too big to
perspective.
fail, exactly.
Yeah.
So there's a small number of countries in that category, and other countries like Zambia, like Ghana, like all these countries that are going through a lot of problems, they didn't get anything, right? So this is very much targeted your Pakistans, your Argentinas, those countries, right? That just borrowed a lot of money, too big to fail, right? Now, the way that's done has also changed. So previously, as I mentioned, China was lending in US dollars. Now they're not lending in US dollars anymore. They're lending in renminbi. Obviously, that's a lot safer.
Mhm.
And it's done in the form of a credit of a central bank swap, currency swap. So the money's been lent by the People's Bank of China, not by the policy banks anymore. The policy banks are actually the People's Bank of China. The central bank is a very large shareholder of the policy bank. So it's not like they're completely disconnected.
They're connected, yeah.
So essentially, it's lending in the money in the currency that it is creating itself. Obviously, that's a lot safer than basically lending in US dollars. And that's all good and well, but it also means that the capacity of these rescue loans to really help these countries is quite limited. But it does have some capacity to support Chinese exporters and others as they work in these countries. Because if you're lending in yuan, basically what you can use that for is to pay Chinese exporters, which would leave you more dollars for other stuff, because the Chinese exporters would be willing to take renminbi, but no one else would. Okay, so if you have yuan, you can pay them, and then it leaves you more dollars to pay for other things. So that's a form of help, and that could help you repay these loans that you may owe to the policy banks, right? And you can also use it, which is what Argentina did, to pay the IMF, because the IMF has the yuan as part of its currency basket special drawing right, the SDR, which is it's sort of, I don't know if people know this, it's kind of international quasi currency that the IMF uses as its unit of measure. So you can repay the IMF with yuan because they take it, and that also helps. So if you're Argentina, that's what they did. They got that and they repay the IMF because they have a massive debt to the IMF, bigger than any other country.
Yeah.
So they're the two things you can use it for, and it's quite limited. So it's not really resolving a debt problem, but again, it's just one of those ways in which you can sort of just kick the can a little bit further down the road. You can maybe continue to uphold exports because you can repay the exporters and so on. You can sort of keep it going, but it doesn't resolve the fundamental problem, and the fundamental problem is potentially one of insolvency, right?
Yeah.
So that's where 60% of the lending is going there. And to make matters worse, as A data showed quite nicely, the interest rates for the central bank swaps are actually a lot higher than the interest rates for the loans that they're replacing. So the debt problem actually is not improving; it's getting worse for a lot of these countries. But they are in renminbi, so there's potentially some big problems coming up as a result. So both the form of lending has changed. And the quantities. And if I may just kind of give the listeners just a little bit more of a kind of to round the picture out, essentially what the Chinese government is now pushing Chinese firms to do is to actually buy into equity and get into longer term investments in some of these countries because they've had enough of these sovereign loans that are often just not working very well. But the problem with that is that it's got to be a good investment, right? These companies are not going to invest in just anything, and that reduces their interest to invest. They're just a lot more cautious now, so they become basically a lot more like a normal capitalist country, if you want. You know, they're pursuing these investments, but these investments have to be relatively feasible. You know, they need to kind of show promise. It wasn't like the mid 2010; it was just like throwing money, vast quantities, at just about anyone who's willing to borrow. So it's a very different picture now.
They need a business case to be able to invest.
Yeah, that's right. You need to show, okay, so how's it going to pay back? What is it? And that puts them in more direct competition, if you like, with the West, which is now trying to mobilize private financing in order to, do various things in developing countries. But private finance really doesn't want to invest anywhere that they can't see a profit. So essentially, we're looking at fairly similar business models now emerging.
Fancy that. Okay, that's great. Well, I guess one big question to sort of wrap this up, and maybe it's more speculative, but do you think that a sort of overall secular decline in Chinese lending abroad, do you think that will have any kind of impact on great power rivalry as such, like for better or for worse, or, not at all?
I don't think that's the main arena where a lot of that is happening. I'm involved with the group, the Second Cold War Observatory, which I think has many great scholars. And I really like a paper that they put out last year. That was without me as a co-author, but there was about 20 people that co-authored that paper. It was published in Geopolitics, where they basically argued that this so-called Second Cold War is very different from the First Cold War in a sense that it's not about capturing territory. It's more about positions within networks. I think that's where a lot of the competition is playing out now. And there's obviously plenty of that going on. So whether it's financial networks, whether it's cyber networks, the internet and so on, whether it's production, and even still infrastructure, connectivity. So that's the kind of stuff that I think we're still seeing a lot of tension, a lot of potential for conflict, a lot of all sorts of potential sort of outcomes from that, and I think that's still going on. I think where we see less of that is actually in the form of sovereign lending and that kind of thing. But there might be more targeted stuff. I mean, for instance, talk about equity investments. So maybe it's about capturing certain sectors within particular countries and then connecting those in certain ways, across borders. I think maybe that's where things are going to go. But I mean, undoubtedly, the world is a far more tense place now than it was, say, 10 years ago. Even though back then, lending for the Belt and Road was at its peak pretty much, 2014, 15, 16. I mean, there's no doubt the world has become a lot more tense since then, even as that has dropped off. So there's lots of ways to compete and to to get into all sorts of problems.
Yes, I agree. Okay, man. Well, the article is called China, International Competition, and the Stalemate in Sovereign Debt Restructuring Beyond Geopolitics with Lee Jones. And I've got here Shahar Hameiri. Welcome. I mean, not welcome. Thanks for,
Still now, yeah.
thanks for coming on the show. This was awesome, dude.
It's my pleasure. Thanks.
Made some coffee. All right. Take care, man.
Thanks, bud.
All right.